Hey again. Um, tonight, whenever you're watching this, we are going to be talking about the stock market and corporate funding and things like that. It's very interesting. Most of my students really enjoy the information they get, and it's something they can use or you can use. So without further ado, we'll get started, and I hope you enjoy it too. So let's get our good old whiteboard out, and here we go. All right. So when you are a corporation, sometimes you will need to raise money for certain things to expand your business or things along those lines. And there are three methods of doing this. So three methods of corporate funding. Okay? And the first one is to issue stock. Now, when you are issuing stock, if you're buying a share of stock, you are buying into the company. So one share of stock equals one share of ownership. One share of ownership. When you own stock, you are a part owner of the company. You have some voting rights. You have some, you're part owner of the company. If the company does well, you profit from that. If the company does not do well, you can lose some money from that, but you are buying into owner of the company. To fund growth, a private owner may sell shares to the public. So that's to the general public, anyone who wants to buy them, or private investors. So how that works, you can take your company public, which means you can just sell it to the general public. Anybody that wants to buy them can buy them, or you can keep your company private. That's what, if you had remembered from the last video, you're talking about entrepreneurship and what Steve Jobs had done with his. He had sold it to private investors. That's what the Chick-fil-A, the Cathy family does. They have stock in Chick-fil-A, but it is sold to members only of the Cathy family. Publix only sells stock to their employees. So if you are, anybody out there listening is a Publix employee, jump on that, because that stock has been a consistent performer, has made money. In fact, I was thinking about going to work at Publix just so I could buy some of that. So take advantage of that. So you have the choice, and then you're just keeping it private, meaning you have a little bit more control over who is part owner of your company and who has a say in how it's run. Something called an IPO is an initial stock sale. So that's the first time you ever sell stock, is called an initial public offering. All right, let's see. I put initial stock sale. Stands for initial public offering there, just so you know what the IPO stands for. All right. So if you want to sell stock, you've never been taken public before, this is one way to do it. You have an IPO, an initial public offering, and you value your stock and so on and so forth. Now, the value of the stock is representative of the value of the company. So you take the net worth of the company approximately. Things are always changing. Nothing's static. I mean, everything's static. It changes. So you take the net worth of the company and you divide it by the number of shares, and this is how you arrive at the stock price. So it's just a quick and dirty method for how you arrive at that. So therefore, when stock is going up, that means the value of the company is going up, and you can think about things that would make that go up. So another way that you can fund growth, if you want to, retained earnings. And that's also what we were just talking about. This is when you save your profit. So you save your profit and you put it in, you keep it in the bank or something along those lines. So you save profit, and then you can reinvest this in the company. You can reinvest the profit in the company. Now, an alternative, if you don't want to save it, alternative is to pay dividends. And that comes from the word dividends, is like dividing. You're dividing the profit among the owners, which would be the shareholders. So divide profit among shareholders. Now, the holders also, as a shareholder, you would get to vote on whether you're going to pay dividends or hold it and reinvest it back in the company. They send out, I said if you're a shareholder, a stockholder, you have voting rights. They send out a ballot and you can check, and that's usually one of the questions on there. Do you want us to pay, do we want to pay a dividend or what? Sometimes now the corporate structure will have where the board of directors makes that decision on their own. But as a shareholder, you vote on the board of directors. Typically, most people just vote to put it back into the company because that's, you make your money off the stock, not the dividends. And so you definitely want your stock to keep going up, which would mean you would want the company to keep expanding, and you'd want that money to fund growth. Now, the third method of corporate funding is to issue bonds. Now, bonds, these are debt instruments. And if you buy a bond, you are loaning the company money to be paid back with interest on a specific date. All right, I almost ran out of the board there. On a specific date. I lost track of what I was doing, didn't I? There we go. So on a specific date. So you loan company money to be paid back with interest on a specific date. Bondholders, now if you're a bondholder, if you're a shareholder, you're an owner. Bondholders are creditors with no ownership or voting rights. All right. So bondholders are creditors, no ownership or voting rights. You're a creditor. Now, if the company goes bankrupt and you're a stockholder, you've more than likely lost your money. Now, they'll take all the assets and sell them, and then they'll pay off the creditors, you know, the ones that like bondholders. So if you're a bondholder, you'll get paid before the stockholders. Whatever's left is divvied up among the stockholders. So a bond, therefore, is considered less risky investment for the consumer. And the reason is because bonds are paid back unless company bankrupts. And paid back before stock if that occurs. So if it occurs, if the company goes bankrupt, then you are first in line, or not first, you're ahead of the stockholders to get your money. All right, so let's talk some about stock then. So you buy and sell stock on something called exchanges. And exchanges, these are the marketplace for stocks. Okay. The main one are the New York Stock Exchange and New York Stock Exchange and the NASDAQ. And we'll talk about those in a minute. Those are the main ones. Those are the largest in the world. The primary market, these are for your IPOs. So you have a primary market, that's the IPOs, and then you also have a secondary market. And this is for existing shares. So it's kind of like, think about it like a new car market. If you buy a new car, you go to the dealer, the new car dealer, that's like the primary market, you buy it. If you keep it for a while, decide you're going to sell it to someone else, you don't take it back to the new car dealer and say, here, we're going to sell this as a new car, it's not new. You take it to the used car market, and that's where you sell it. So that's the same premise there. And let me tell you about bulls and bears. All right, so bulls and bears. A bull is when the stock prices are rising, and it can indicate that the economy is expanding. All right, so bull is when the stock prices are rising. Bear is when the stock prices are falling, and it can indicate a possible contraction. And I say possible because it's not always that, but sometimes it is. So for the bull market, you have, all right, so here's an easy way to remember it. So if stock prices are rising, that means the economy is doing well in the bull market, and so that's a good sign. That's an indicator. Stock prices are rising, that means companies are making money, the business community is expanding, things are good, expansion. If it's a bear, stock prices are falling, that means businesses aren't worth as much money, there's losing sales, things like that. It's a possible contraction. It could also be just an anomaly. Something's happened, maybe there's a shock or something. It doesn't mean we're going into a contraction or a recession. It just means that something has happened to make investors a little nervous at the time. A good way to remember that is to think about, and I'm going to get full for this one. All right, a good way to remember which is which is, if you think about bulls have horns on the top of their head, and if they're going to fight you, they're going to come up like that. They're going to gore you in whatever body part they can get hold of, and that's how a bull does it. Bears, if they're going to fight you, they stand up on their hind legs. See, I'm a bear now, and coming down on you with their claws. They come down on you. So think about this. Think about how they fight. That's how you remember. Bulls fight up and bears fight down. And that's how you can remember bulls versus bears. And that looks like something you would teach a little kid about the stock market, but I still find it very fun. So I hope you did too. And you can see why I had to go full screen to show you that one. It's really fun if you're in the face-to-face class and you can see me do that. All right, so let's talk more about exchanges, the New York Stock Exchange and the NASDAQ. So NYSE is New York Stock Exchange. All right. It was founded in 1817, so it's been with us a long time. And it's actually not owned by a New York company. It is now owned by Intercontinental Exchange, which is abbreviated ICE. And the headquarters for ICE are here in Atlanta. So the New York Stock Exchange is here. Now, they still have the actual New York Stock Exchange on Wall Street there, and they still do some trading there. Things are very different now because everything's all electronic. They still do some trading there just for, for symbolic purposes and out of nostalgia and things like that. But it's all a lot more high tech now than it used to be. So ICE owns 23 exchanges in the US, Canada, and Europe. Plus, it also owns some clearinghouses, some equity markets, things of that nature. But they own 23 exchanges, including New York Stock Exchange, which is still the largest stock exchange worldwide. So we still have the largest right here. Trading used to be via an auction, but now it is electronic. And it used to be something fun to watch too. You would go in and people would wave their little papers and say, I'm selling AT&T I've got 20 shares of AT&T at $200 a share. And then somebody'd say, sold, I'll buy that. And then they trade papers and they do it that way. Or somebody say, I'll bid you 210, no, I'll bid you 250. Anyway, so things like that. So that's how it used to be. And it was a lot more chaotic, but a lot more fun. Now, of course, it's just boring people typing out on computers. But still worth going to see if you happen to be into that and you're there. So the hours that it's open are from 9 a.m. to 4 p.m. So that's where the sound of banker's hours came from. That's where the thoughts of banker's hours, right there, 9 a.m. to 4 p.m. And then it's opened by the sound of ringing a bell. Now, here's some interesting stuff for you, is that the bell sound, and you'll hear that ding, ding, and the bell sound is trademarked by the New York Stock Exchange. The bell has been replaced, but they have remanufactured a bell to get that traditional sound. So the hours are 9 a.m. to 4 p.m., so it's not even a full day's work. And so it's definitely from the old elite style of doing things. And sometimes they will invite famous people in to ring the bells. So a few of those include Snoop Dogg, Kiss, the rock group Kiss, Mickey Mouse, Darth Vader, and Darth Vader came with stormtroopers. This was to celebrate 30 years of Star Wars. Hilary Duff, the Taco Bell Chihuahua, Robert Downey Jr. when Iron Man came out. So sometimes they do it as a marketing thing. Now, the very first bell ringer was in 1956. It was a 10-year-old kid named Leonard Ross, and he was invited because he was on a game show and won the game show. There were a lot of questions about the stock market, so they invited him to ring the bell as part of his prize. So very interesting stuff there. There's a video of Darth Vader ringing the bell, some of those things. So if you're interested in that, you can look up. If you're a Sex and the City fan, they did have Sarah Jessica Parker ring the bell. There's an episode where Carrie Bradshaw rings the bell, and that actually was to open trading that day. They had that. She actually did that, and they filmed it for the show. So just some interesting tidbits for you. Now the NASDAQ, and that's fun to say, and it stands for, and I'm not going to make you write this down, but it stands for National Association of Securities Dealers Automated Quotations. Try saying that 5 times fast. Not even a tongue twister, but it's not fun. So it is the second largest exchange in the world. All right, so the second largest, the NASDAQ, it was founded in 1971, and it was mostly tech stocks, and it still is, truthfully. I mean, Facebook and some others like that, it's still mostly tech stocks. And now the New York Stock Exchange was like an old gentleman's club, you know. They had some very strict requirements, and you had to pay these huge fees and all that stuff. And so tech stocks, they were young and brash, and they wanted something different. They thought, why am I paying all these fees? I just want to sell my stock. So they founded the NASDAQ so that they could do that. And it was way more down to earth and progressive, if you will. So the NASDAQ conducted the first online trading. Well, let's see. Oh, I have these reversed. The first electronic trading and the first online trading. So electronic was first, and then the first online trading. So first electronic and first online. Makes sense since it's founded with a lot of tech stocks. Also, they operated extended hours from 7 a.m. to 8 p.m. So they had some extended hours because you've got these young movers and shakers. Tech people don't sleep. They just keep working all night. And so naturally, they wanted it open and they could trade later. Just the way it works. Now, here's something interesting. They don't like financial companies. So it's only non-financial companies allowed. And for some of theirs, they have some strict requirements. A few of those, I'll just give you a couple of those. Non-financial companies are allowed. Also, no bankruptcies. So you could have declared bankruptcy in the past, but you can't currently be going through one now or even talking about it. And you have to have a daily trading average of greater than 200,000 shares. All right, so you have to be relevant, have to trade a lot of shares. So that's the way, that's just part of it. There's more, but that's just a few to give you an idea of how strict they are. Okay, So let's talk about a couple of stock indexes. So the first one is Dow Jones Industrial Average, which you can see it as the DJIA, but more commonly you just hear it called the Dow. And so the Dow, this is a stock market index from the Wall Street Journal in 1896. Now, the founder of the Wall Street Journal, his name is Charles Dow. So he and Mr. Jones, that's where the Dow Jones came from, he and his partner. And they founded the Wall Street Journal. And of course, the Wall Street Journal was the one that came up with the Dow so that people could track their stocks. That was when people started investing more and businesses started doing this more and growing. And so that's how that got started. So right now it is the definitive benchmark, meaning it's the most closely watched. So it's the definitive benchmark to tell you how the stock market's doing. Okay, so it's the most closely watched to see if the stock market's doing well, if it's healthy, all that sort of things. It's made up of elite blue chip stocks. So they're called blue chips. And what that means is they are consistent performers. So these stocks are consistent performers, meaning they're consistently going up in value. They rarely ever go down, and if they do, they usually bounce right back up. And so they're called blue chips. So they're considered really good investments in that case. So it's made up of 30 members who best represent the American economy. So they best represent the American economy, or rather the composition of the American economy. And you can be dropped from the Dow if you have a low stock price, or if you no longer represent the economy. So if you're a product that's not useful anymore, if you're no longer relevant, you can be dropped, or if you have low stock prices. So you have to be, again, you have to be valuable and relevant pretty much. And then it's a price weighted average, which means that higher price stocks have more influence. So just because you're a valuable company does not mean that you're necessarily going to be on the Dow, because if you have too high of a price, you can throw off the average. For example, Berkshire Hathaway, that's Warren Buffett's company, and it's one of the most valuable companies out there. But each share price costs $302,000. Now he does that so that he wants the benefits of having a publicly traded company without actually selling the stock to the general public. Now there's some subsidiaries that or he's broken off some parts of his business that you can invest stock in, and those are lower priced. But the main company itself, he wants to keep control of that, and I can't blame him there. So Google had been kept out of the Dow, and some others, because their prices were just too high. But it's made of people who best represent, companies who best represent the American economy. So you have some in food, some retail, some financial sector, some manufacturing, different things like that in the Dow. So you have things like, let me see, I had some of the ones there. GE has been on the longest, General Electric. That's one. I have that list right here for you. Give me 1 second to figure that out. Aha. Here we go. Let's see. Microsoft, Nike, Walmart, Coca-Cola, American Express, IBM, Disney. Some of the ones who've dropped off, you have Kraft and General Motors and things like that. So those are some of the ones that are in the Dow. So you can see some of those companies, you can definitely tell that they are some of the movers and shakers and do represent the economy. But now some people think that the Dow is outdated and that we shouldn't be looking at that as the definitive benchmark. So they like something called the Standard & Poor 500. And you will also hear that called the S&P 500. And the Standard & Poor 500, this is also an index. This is a ratings index of, but instead of 30, you've got 500 large companies. It is a good indicator of trends and is slowly replacing the Dow as the leading indicator. All right, so it's slowly replacing the Dow as the leading indicator. Some people think that 500 companies is a better representation than 30. They think the Dow is outdated because it's still the same. I mean, the companies are different, but the structure of it is still the same as 1896. I'll render my verdict in a minute. This one includes various industries. So there's not as much discretion with their requirements as with the Dow. The Dow, they can look at someone and say, okay, no, it's a price-weighted index. We're not counting you. Standard & Poor, their requirements are a little bit different. So they said that it's going to be a truer makeup of the economy, and here's why. Because it uses the total value of stock. And the total value, I mean the number total value of stock. And by that, I mean the number of shares times the price per share. All right, so rather than just the price, they use the total value. Number of shares times price per share. So you're looking at the company's, the approximate net worth of the company. To make the list, companies must have a stock value greater than 4 billion. They must have a stock value greater than 4 billion, and they must trade greater than 250,000 shares per month. All right, so you have to be, again, you have to be valuable and relevant. All right, so you have to be valuable and relevant, and that's their qualifications. So a lot of people think that this is a better measure of, of the health of the stock market than this. Now, my verdict is just check both of them. Truthfully, if you look at both of them, if one is going up, the other one's going up. They move in tandem. If one's going down, the other one is. So they're right next to each other. Just check both of them. It doesn't really matter which one is best. You can just check them both. Now, if you are interested, let me tell you a little bit about mutual funds first. If you think that buying shares of stock in one individual company is very risky, because what if that company goes out of business? You lose your entire investment. There's some truth to that. A lot of people invest in something called mutual funds, and so instead of buying a share of stock, which you would have to save up, Apple stock is like $280 a share roughly, so you would have to buy a share of Apple, you'd have to have $280. But if you buy shares in a mutual fund, so you're putting money into the fund takes everybody's money, pulls it together, and buys shares of Apple stock. And if the fund makes money, then you make money. So you want to look at these funds. It's a great way to invest. It keeps you from, it's a less risky investment, and it keeps your money diversified, and then you don't have to pay attention to it. So if you're not a day trader, that's not your thing, or you're just getting started, this is a great way to build wealth without having to assume all of that risk involved with it. And they have mutual funds for anything. For example, so one of the ones that I like to invest in is the Standard & Poor fund, and it's just comprised of these 500 stocks. There's some Dow funds as well. But since Dow's only have 30, Standard & Poor usually is a little bit cheaper to invest in. So it's a great way to get started with that. If you are an environmentalist, they have funds that are green funds. They invest only in companies that are friendly to the environment, things like that. So there's other ways you can do, but definitely go back and look at the history. Look at as much history as you can. As far as investments go, I will say that 95% of 5-year periods in the stock market have made money, and 100% of the 10-year periods have made money. So definitely don't write this off as an investment. Just be wise about it. And if the information I'm giving you here is enough, absolutely look at more. You can come talk to me. You can talk to a broker. You can do your own research, whatever. But make sure you understand what you're doing before you invest, because I don't want to see any of you lose money. I want to see you all, I want to see you in the papers being millionaires and billionaires, and I can say, yes, I knew them when. All right. So let's talk about a stock split, and then I'm going to give you Warren Buffett's advice, and that'll be it for this one. So a stock split. Now, the rules of supply and demand apply with stocks as well. So we're going to look at a graph. This is for what happens when a stock splits, and we're going to use Apple as our example because they had a stock split not too terribly long ago. So we're just going to use supply and demand. So there you go, you have that, and then we will have the price of stock right there, and we will have the quantity of shares down here. All right, so the price and the quantity of the stock, and let's draw a demand curve. So you're going to have just a normal, regular, standard demand curve right here. There you go. Now you also, but stock is different because stock does not have the typical supply curve, okay? Because your supply curve for stock, you have a set amount, a set quantity at any given time. So it's going to be a straight up and down line, all right? So here's your supply of Apple stock right there. And if they want to issue more, they'll issue some and then it'll, go to the right. Or if they want to buy back some and take it off the market, the supply goes to the left. So with that in mind, you have the supply and demand intersect right there, and you have the equilibrium price of stock. Right there. All right, so there's the first one. All right, so there's your equilibrium price. Now, what happens in a stock split, they take every share and they just split it in two. So think about it in terms. So Apple did a split. And they did 10 for 1. So for every share you had, they just turned it into 10. So it's like if you have a pie and they take the pie and cut it into 10 slices, it's still your pie. You still own it, but it is cut into 10 pieces. So that's what they did. And it's still the same amount. So here's what it looked like. So before the split, there was S1. Okay, so this before the split, you might have one share of Apple, let's say at $500, at $500 each. All right, so each share is $500. So you had one share at $500 each. Okay, so you had a total investment equals $500 investment. All right, so that's how much you have. All right, so after the split, they're doing 10 for 1. So you have instead 10 shares at $50 each. So you had 10 shares at $50 each. So that's a total investment still of $500. All right, so you still had it. You just had 10 slices. You still had one pie, but you just had 10 slices instead of, think about like calories. You have one pie, let's assume it's 500 calories. And by the way, I would love to find a pie that's only 500 calories. I would eat it all the time. But instead, so you cut it into 10 slices. So now you've got 50 calories each, but add them together, still 500. So that's where you're at. So what it looks like on the graph is you have this new, they've increased the supply. So now you have S2 after the split. You've got S2, and then you've got a new stock price down here. All right, so that stock price is, you've got a new equilibrium stock price at $50, and up here it is $500. Okay, so you've got $500 there, $50 here. See how that works, but you've still got the same quantity. I mean, this is not you, this is the market, but you've got the same quantity. You can see that over here to the right, what I wrote there. All right, now what happens when stock prices, now this is your investment, but let's look at the general public. So stock prices have gone, so people want to invest in Apple because it's a good company, but they couldn't afford $500. So now this price is $50. So what are they going to do? They're going to jump on top of that, aren't they? Uh-oh, I erased it. Ah, dagnabbit. All right, let's draw it back real quick. I hit the wrong button. Nerd. Okay. There's your demand. All right, S1. And this is your price of, and I'm just going to put $500 right there. Okay. And then we did S2. Sorry about that, folks. I hit the wrong button there and erased it. So S2, and here's your new price of, you've still got yours, so you can, $50. Okay. And you remember all that stuff I wrote to the right. All right. So now all of a sudden the price is $50. So what's going to happen is there's going to be a higher demand. So you had demand 1 right there, and now we have demand 2 right there. And look at that. Price is back up again, isn't it? And now it's even higher than that. So I'm not going to put, let's say it's 600 or something, but we'll put P3. We'll call it P3. So see, that's how that works. So now demand has gone up, and therefore price goes up as well. So why would a company split their stock? That's what somebody said. They don't seem like they gain, but they do. They do that to drive the price up because they were right here, and now they have more stock back up at this higher price. So Apple has made more money. People are buying more at a higher price. Their company is now, this has driven up the value of their company. So not only is it the net worth of the company that this stock represents, but it also represents demand for it. If there's demand for it, people are going to buy it. That's going to be, that's going to drive up the price and make it more valuable. That's going to drive up the value of the company. There's a lot of factors at play here, but it's a very interesting thing to see. All right. So now let's finish up with some advice for our armchair investors here, our new investors, or maybe you're already investing, but you can still use this advice. And if you've heard it before, then just nod along with me. But Warren Buffett, if you've heard of him, he's called the Sage of Omaha, and he is just a fantastic investor. Inarguably one of the best of all times. And so here's some of his advice, his best advice for investing. And that is invest in what you know. Some of the best money he ever made was on investing in Wendy's stock. And he loved to eat Wendy's. He's very down to earth. He wasn't eating fancy. He liked to get a good old Wendy burger. So he would go to Wendy's, and he noticed that the food good, the prices were reasonable, it was clean, the staff was friendly, they always had customers there, and all those things in his mind added up to a well-ran business. So, of course, the financials are involved too, but one of the main things you need to have a successful business is customers. So he bought stock in the company, and it worked out for him. It was a great investment. He also bought the company Pampered Chef because he saw the products were great, and everybody in his office, males and females alike, were just raving over these kitchen tools. He liked the business model, the practice, the way the company was ran, and he bought it. So his advice is buy what you know. Think about, where do you shop? Where do you like to eat? What are some brands that you like? Is there a certain company that has proven valuable to you over the years? You know, like for example, my husband and I both, we love Ralph Lauren. We've been buying Polo clothes and Ralph Lauren clothes since we were in high school. So, and it lasts well. The company's 50 years old. That's something to think about, you know, perhaps a company like that. I mentioned Publix. I would love to invest in Publix. I'm tempted to get a job there just to buy the stock. But I shop there. I noticed that it just like Warren Buffett was saying with Wendy's, it's clean, the staff is friendly, it's always well stocked, it's well lit, it has a good quality stock, you know, things that I want to buy. There's always customers there. The prices are reasonable. They ran great sales. All these things that to me add up to a good business. And if you look at the track record along with that, you see that it has ran a good business. So think about things that you know. Where do you like to eat? If Red Lobster is one of your favorites or Longhorn, then perhaps you look at Darden Group because they own those companies. And then you look and you say, oh wait, they own Red Lobster and Longhorn. Those are two of my favorite restaurants. So there you go. There's something to consider. Perhaps that's a good investment for you. But think about, evaluate. How do you evaluate a place as a consumer? That's also some of the criteria you should use as an investor. Then add in the financials and see, is it making money and things like that. What's the debt load like? That type of stuff. But always, initially, you can look at what do you think about the business in general. All right, so that is the advice. That is where I would leave you. Okay, so we done pretty well there, haven't we? Haven't we? The stock market, and I was just timing this one. I never timed these, so I don't know if they're too long or cumbersome. You know, if you're sitting down with your popcorn and soda, because it's like watching a movie, and probably not an Oscar winner. But anyway, I hope so. I hope you've enjoyed that. I hope you've gotten some stuff you can use. And next time we will be talking about market structures. I'm not going to get to that tonight because it is night when I'm recording this and I'm tired and hungry. So I will let you go with this, and I hope you have a good afternoon, evening, or good night, or good morning.